Hello, everybody, and welcome to the third quarter market review for 2022, where I will review the most recent quarterly performance for U.S. and international equities, as well as commercial real estate and fixed income. Once again, I'm Sergio Mariaca with Mariaca Wealth Management, and just like all of my other videos, I try to break down some of the key principles around investing in a way that's understandable so that hopefully you can be a more informed and disciplined investor. Now, before I get started, I need you to know that past performance is never a guarantee of future results. We certainly hope so after this year. Next, everyone's situation is different, and this information is for general purposes only. It does not constitute investment advice or a recommendation of any kind. Okay, as I film this, we are already 1 month into the final quarter of a very volatile year, and we're still dealing with persistent and 40-year high inflation, a Fed committed to bringing it down, and of course, the ongoing war in Ukraine, plus a number of other issues, including the upcoming midterm elections here in the US. But let's focus on inflation. Insofar as we can determine, the current high level of inflation is due to the pandemic in two important ways. First, when economies around the globe were forced to shut down in the beginning months of the pandemic and then required employers to have mitigation plans in place to attempt to control COVID, we were dramatically reducing the regular supply of goods that we all counted on in a more normal time. And when you reduce supply and demand holds steady, prices rise. This is simple economics 101. But demand did not hold steady. In fact, we dramatically increased it with the massive stimulus programs designed to keep people fed, housed, and employed during the pandemic. So the imbalance between demand and supply was even more profound. But we weren't done yet. Unfortunately, our policymakers at the Fed, who have a mandate to keep prices stable, sat back and watched as year-over-year inflation began to skyrocket in the beginning months of 2021 and increase all the way up until March of this year before they began raising interest rates. A perfect storm for inflation to increase and set in for sure. Now, I want to be fair with respect to the stimulus because I think it was mostly good and necessary and may have saved us from massive small and medium business failures and possibly a much deeper crisis than we're experiencing now. One that possibly would have required the same or more government spending to address. Okay, so I'm going to do something different this quarterly review than in the past. I'm going to briefly review the quarterly and longer-term performance for U.S. and international equities, as well as commercial real estate and fixed income. And then I'm going to dive in and review the past bear markets, recessions, and the ensuing recoveries in hopes that you will feel more confident in our economic future and your investment strategy going forward and through this crisis. And as I do it, I'm going to highlight 3 of the top criticisms that I continue to hear, especially during times like now. Number 1, it's different this time. We'll look at that. Number 2, I'm too old to invest and recover. I have to be much more conservative. We'll take a look at that. And then the last one is, I'm retired. I should not have any exposure to equities going forward. And we're going to look at that one as well. And then I'm going to close with things I believe you should be focusing on if you want the higher performance that generally comes with a long-term approach. All right, let's go ahead and start with quarterly market returns. And these are the third quarter of 2020. U.S. stocks down about 4.5% as measured by the broad benchmark, the Russell 3000. International developed down about 9.2. Emerging markets down about 11.5% this quarter, and then global real estate down about 11.12. And then bonds just continue to have probably one of the worst years I have ever seen, maybe the one of the worst years ever, with the broad U.S. bond market down about 4.75 and then international down about half of that. What I always like to point out is, as bad as this quarter was, we've seen much worse for U.S. equities, where we set the record back in 2008. In 2020, the first quarter of the pandemic, we broke the record for worst quarter for international emerging, or developed rather, and then for emerging and real estate, the quarter still, worst quarter record still stands back in 2008, just as it does for U.S. equities. And for fixed income, I mentioned, I think this year is probably the worst. We set the worst quarterly record for U.S. bonds in the first quarter of this year, and the same for international bonds. Looking at 1, 5, and 10 years, here we can see the Russell 3,000 over the last 12 months, 4 quarters down about 17.6%. International developed down about 24, emerging markets down 28, and global real estate down about 20.5. And then look at this. This is just incredible to me. I don't remember ever seeing a year where the U.S. bond market was down about 14.6% and global bonds down about 9.86. There was no place to hide over the last 12 months. But this is where we need to focus if we are long-term and disciplined investors. Even with all of this horrible performance, you would have still averaged about 11.39% per year over the last 10 years, even though so far you're down about 17.5% over the last 12 months. International developed and emerging markets have underperformed over the last 10 years than what we would expect in other 10 years or what we've seen in other 10-year periods. We've talked about that before. And then we've also talked about how U.S. Real estate's doing a little bit better than international or global real estate, which is a component of over the last 10 years. And then even as bad as bonds are doing this year, could be the worst year on record. And even with the low interest rates over the last 10 years, you're still above water in U.S. and international bonds. All right, let's focus on previous crises. And my goal is to hopefully give you some confidence in how we're going to proceed through this crisis for our economy, as well as for your portfolio and your financial plan. And it all comes down to having a plan. And I'm going to share a couple of quotes here because I think it's just a great way to capture an important idea or a concept. And this is one of my favorites. Under pressure, we don't rise to the occasion. We sink to the level of our training. And we're not sure who originally authored this quote, but many people are attributed and use it because it's just a great way of saying you need a plan. And with respect to managing a portfolio, you need to know that you're guaranteed to give back some of your previous earnings. You're guaranteed to have periods where you lose principal, usually in the beginning years, and then after you have a number of positive years, then you're going to be giving back some of those previous gains you've had. And you need to have a plan of what you're going to do when you come across a pandemic, a financial crisis, a bear market, a correction, a recession. How are you going to behave? Do you have a plan that's going to get you through that and continue to provide you the income and whatever else you need from your portfolio? And we're going to talk about that. Here's another great quote along the same lines. Great investment experiences treat most portfolio decisions as non-decisions. They've been pre-decided because you had a plan and are immune to market prices. Doesn't matter what the market's doing, my plan still stands. Sentiment and human judgment. They remove agency and thus reduce regret. Markets are historically volatile and you need a plan which understands that. Okay, so this is a 60-40 portfolio, and between 2012 and 2021, I just built it with 2 components. We're using the Russell 3000 and then the Barclays Aggregate Bond Index. And so the Russell 3000 averaged about 17% per year during this period. And the bond index about 2.5%, underperforming historical inflation, which we assume is about 3%. So in real dollar terms, you're losing money in almost half of your portfolio. And I can't tell you how many times I've sat down with somebody and I've told them, hey, listen, we've had another really outstanding year in US equities. Isn't that wonderful? Oh, by the way, the other half of your portfolio is only up 1%. Or 1.5%, because interest rates have been very, very low. And oftentimes some folks will say, well, why don't we move some of that money into this column, because we know the market's just going to continue to go up. And the reason you don't do that is because if you're retired, you might need income during a recession, bear market, a pandemic, and we can't always see them before they happen. And so this is part of our plan, to always have some stable assets and always have some long-term assets that are exposed to risk and should grow long-term. All right, here's another great quote. And this is from David Booth, who is the CEO and founder of Dimensional Funds, who we use quite a bit in our practice. Imagine it's 1997 and you have a crystal ball. How would you invest if your crystal ball revealed that over the next 25 years there would be a Russian debt default, long-term capital management, which was a very large hedge fund, would fail, a dot-com implosion, 9/11 attacks, financial crisis, a great recession, a pandemic killing millions, and 3 market crashes? What would you do? Would you put any money into stocks if you had a perfect crystal ball and you had this complete information and view into the next 25 years? Well, if you decided you would just put your money into CDs and bonds, you missed a great opportunity, because the Dow started 1997 at about 6,400 and it ended, this is 1997, ended 2021 at just about 37,000. So even with all of this chaos, you would have missed out on a tremendous long-term return. So just remember that. All right, so we've seen this before, and this is kind of what happens. You know, right around here is when all the CD buyers start buying Bitcoin and getting into the market and just getting really irresponsible, getting way too aggressive. This is when many investors might take that portion in the 40% of their portfolio and put it into stocks, and the market is doing great. This is when it's easy to be an investor because everything is going up. But then periodically, and I'm going to share with you how often we see this, the market falls for a number of reasons. And this is where people, and the reason it's falling is because people are getting emotional, or they don't have a plan. Maybe their plan is all in or all out, and that's fine. And so they start lightening up on their equity exposure, or they get emotional and they just dump everything because they think it's going to go down forever. And it seems like it is up to a certain point, and then it starts recovering, and the cycle repeats itself. So you just need a plan for what you're going to do in this kind of environment, and you need a plan for this kind of environment, because over the long term, markets are volatile, and every 10 years or so, we have a pretty big pullback in the market, a financial crisis, if you will. And about 20%, 25% of any 10-year periods, we have a down market as well. All right. So let's just go ahead and revisit some of the reasons why we want to invest in risky assets, and it's because this is considered a risk-free asset. So if you started with $1 back in 1926 and you put your money into Treasury bills, at the end of 2021, you'd have $22. Not a lot. Nice return, but going from $1 to $22, but that's about 95 years there. And so what we know, though, is as we add risk, as long as it's diversified, we get a higher return. So if you go into longer term bonds and they have more risk because they're longer term, that's term risk, we would return not $22, but $194. And then if we go into U.S. large cap stocks since 1926, our $1 would grow to $14,000. Now, that's some serious growth. And this is clearly riskier than both of these. So you are compensated over this long period of time by that additional risk. And then if you want to take even more risks than the big companies, you would invest in a small cap index. Small companies tend to outperform large companies over longer periods of time, but because they're small companies, they inherently have more risks than the larger companies. Okay, here is that first complaint that I hear from investors all the time, and that is, it's different this time. And it is. It's always different. The circumstances of any pullback, financial crisis, or global situation we're dealing with at any time is different, unique. But we've seen lots of unique and different and horrible situations in the past, and markets have just continued to slowly grind ahead over time. And so from 1970, if you put $1 in the Morgan Stanley Country Index for the world net of dividends, you'd have $98 at the end of 2021. That's a pretty good return, even though, here you have a year where the market is down. We have this war that started over here. We have 9/11, terrorist attacks, Y2K, remember that, the savings and loan crisis, oil prices quadruple. The S&P is down 43. U.S. inflation hits 13.5%, 50% higher probably than where we are right now. Even through all of that and a global pandemic killing millions, you still would have grown your assets. So even though it is different this time, they all seem to end the same way, and that's with a nice bull market and recovery after the current crisis. And I'm going to share with you some of those numbers. All right, when we stack all the years in the market up based on if they were positive, so here's all the, in this column, 0 to 10%, between 10 and 20%, 20 to 30, 30 to 40, and 40 to 50, and then we had 1 year that was greater than 50%. 75% of the years over the last 95 years or so, the market is positive. 25% the balance, the market is negative. A couple of interesting things that I see here is when it's positive, it's tends to be more positive. The biggest column for down years is down between 0 and 10%, so not down that much. The biggest column for up years is between 20 and 30%. I believe this statistic is fairly close, but 80% of the years where the market's up, it's up greater than 18 or 19%. Another thing that we tend to see here is the best years follow some of the worst years. So the worst year on record, calendar year, was 1931. The S&P 500 or this index, which is a broad index, fell by 43.5%. The very next year was 1932, and that was also a down year. That was down 8.6, and then wouldn't you know it, it's followed by the best possible year we've ever had on record. And you can do this all day long. You can identify some of the worst down years and then find the corresponding best year. And so, for example, the next worst year was 2008. That's a great financial crisis, and that was followed by 2009. So the market went down 36%, followed the next year by 28.8%, and then you were into the next bull market. So quite often, best years follow worst years, best days can follow worst days, best weeks follow worst weeks, and we've seen that before. I've got some more data on this. All right, so let's look at momentum. So what happens when the market hits a new high? So in the calendar year where the market hits a new high, what happens over the next year, the next 3 years, and the next 5 years? Well, we continue to see momentum. The market continues to do well. After the market hits a new high between 1926 and 1921, the next year averages about 14%, each of the next 3 years about 10%, and each of the next 5 years by 10% per year. So if the market hits a new high, generally you're going to continue to be pretty happy. How about if the market hits a low? So it has a correction, and correction is more than 10%, bear market is more than 20%. So in the year that follows a correction down more than 10%, the average year ahead, it's up about 11.4. The next 3 years after that correction averages about 10%. The next 5 years averages about 9.6%. So when the market hits a new high, there continues to be positive momentum going forward. When the market hits a correction, loses more than 10%, the next 1, 3, and 5 years continue to be very positive as well. So good momentum statistics there. All right, this is another really important one. And the importance about this one is that missing only a few days of strong returns can drastically impact your overall performance. And this is why you don't want to jump in and out of the market, because you're likely, you possibly by getting out of the market, you could miss some down days and preserve some losses, but you're likely not going to get back in time. We had a client webinar in July with an economist, and he showed us data that oftentimes the ensuing bull markets after a recession start 3 to 6 months before the recession is even over. So GDP continues to fall, unemployment continues to increase, all the while the stock market is already into the next upcycle, and most people would not be able to understand that. They wouldn't catch those really strong days, those strong returns, and that would impact their overall long-term performance. Okay, so if between 1990 and 2021, you were invested in the S&P 500 the entire time, you'd average 10.76% per year. If you missed the 25 best days over those 30 years, so not 25 days per year, that's 25 single days, and you were in cash over the 30 years, you would have cut your performance from 10.76% per year to 5.55. And wouldn't you know it, many of those days would occur at a time where you and I would not be able to tell that we are already out of the previous bear market or recession. Okay, let's go ahead and look at intra-year gains and declines between 1979 and 1921. The lesson behind this one is we are in a very volatile market. So we are showing, this bar graph are the years, the performance for the U.S. market. So let's pick on 2020 because we remember that. If you remember 2020, after that first quarter when we shut down the government, unemployment spiked up to 15, 16%, and the market lost, 40%, within just a matter of a couple of days or a couple of weeks. I don't remember exactly. But then we had the stimulus programs, and that injected a lot of liquidity into our economy, and markets and stock prices came back dramatically. We finished up very nicely for that year, but this is the volatility. So we were higher, much higher, and much lower through that year, even though we were positive. So we can look at all of these positive years, and these are called little whiskers over here. Even in very positive years, you will still likely have a period during that year where the market might be down. And so we just need to understand that markets are inherently volatile, and we have to have a plan for that, unfortunately. All right, let's look at bear markets. Between 1929 and 2020, these are all the bear markets. Now, bear market is when the market falls below 20%. Back in 1990, that was actually 19.9, but we're going to call that a bear market because there was an ensuing recovery after that. So we've seen some doozies. This is the Great Depression, and this is the pandemic. We don't have this year in there yet because it's not done. But here are the stats. So of all the previous bear markets, the average loss is about 38%. We're not there yet for this year. And they last about 18 months. We're probably a year into it. So if this one's going to be 18 months, it's over sometime in next summer, which means the market could start taking off 3 to 6 months from them. That's just using these averages and overlaying them over our present situation. Of course, I don't know if that's the way things are going to play out. Let's look at the corresponding bull markets. These are bull markets that follow the bear markets we just saw. And we can see that some of them are really, really huge. And in the modern era, we've had two really big monster ones since 1990, where we had returns of over 400%, which is just outstanding. So here are the statistics for the average bull market. Average gain is about 178%, and they persist for about 60 months. So the downturns are about 18 months. The ensuing recoveries are about 60 months. And in the average recovery, you will get all that you lost and then some, on average. When we put them all together, we can see the scale. So they look a lot deeper in that first chart when we're only looking at the bear markets, but when we put them next to the corresponding bull market, they do not look as terrible. So this is the most recent pullback and then the ensuing recovery before we hit 2022. Okay, so let's look at the market's response to crisis for a 60-40 portfolio. So that's that balanced portfolio, and we want to understand how long would it take to recover. And you're not taking income in this situation, although I do have an example of that. So these are the last 7 major crises where we are beyond 5 years. So we're not beyond 5 years from the pandemic. We'll have that data in a couple of years, I imagine. But if we look at the last 7 crises, there's only 1, 2, and 3 where the 60-40 portfolio is negative after 1 year. And these 2 crises actually follow each other they actually overlap. So this one is in 2000 and this one is 2001. So the reason this one is still negative for 3 years and none of the other ones are is because you've got that second crisis happening with 9/11 after the March 2000 dot-com crash. But all the other ones, after 3 years, you are well on your way to recovery. And again, this is a 60-40 portfolio. And then across the board, after 5 years, we're doing really, really well. And so this is, this is providing evidence that you possibly want to stay invested in a 60-40 portfolio through these kinds of pullbacks that we see over time. All right, well, let me just paint a really simple picture of how somebody can be in a 60-40 portfolio between 2005 and 2012. So I picked a few years before the financial crisis of 2008 and a few years after. And this is what this investor is doing. We're starting with 2005 with $1 million. They want to take out 5% a year, and I'm taking that distribution each year after they get the performance of the 60-40 portfolio. We're using the dimensional wealth models return for the year. We're not doing any kind of exotic rebalancing. This is just simple math. You get the return, you subtract your income, and then your ending balance starts the next year. Now, I'm increasing the income every year by 3% because inflation continues to happen. Even though inflation this year is much higher, we tend to think of historical inflation about 3%. So we're starting with 50,000 the first year. The next year it's 51,500, and then it goes up from there. All right, so 2005, you end with $1,025,000. You got your income. The next year, your portfolio continues to grow beyond the distribution that you take. The next year, you have another positive year, up 8.2%. You now have a new high portfolio value based on just these years. And then we come across the great financial crisis, and a 60-40 portfolio in 2008 during that calendar year would have lost about 25%. So you start off at about 1.1 million and you lose 25%. Then you subtract your new distribution because you still have to live and eat. You're retired. And you end the year at $814,000. So this example is addressing the criticism that I don't have time to recover if I lose a lot of money in my portfolio. And here is somebody that in 2008 is retired and they lose 25%. And believe me, they're not happy. They're not sleeping well. It is difficult if this is the first time you're going through this, and all you have is a financial advisor trying to keep you in your plan. All right, let's continue. So 2009, we start with that $814,000. Of course, oftentimes good years follow bad years. So this next year, the 60-40 portfolio is up 25.4%. You're now taking out $56,000, so you end the year recovering a little bit more of your money, $964,000. The next year, the portfolio is up 12.7. You take your new income distribution, and we're now above $1 million. 2011, the markets or this portfolio is virtually flat, down about 1%. We take out $59,000. We end up just shy of $1 million. And then the following year, we break through $1 million once again as the portfolio rises by 11.9%. We're now taking over $60,000 a year in income. And so through 2012, so 2005 to 2012, we took a portfolio that started at $1 million, got back above $1 million, and we've distributed $444,000 in income to complement our Social Security if we're taking it, or any other pensions or income that we may have. So you can survive these kinds of situations, at least the financial crisis of 2008, if you continue to keep your portfolio invested and balanced, and you need to take income, and you can actually add some inflation to that income each and every year. So you can survive these kinds of situations. Difficult, it's emotional, it's never easy, but it's part of having that plan. Okay, here's another situation. So I'm just painting another simple way to look at this. And this idea is, I'm retired. So here's a person who's 65 and his spouse is 62. So with men who are 65, their average spouse, I did the research, would be 3 years younger, 62. We now have, you're retired with $1 million, and you need to take out $5,000 each month. That's a distribution rate of about 6%, and it's probably higher than we would suggest for somebody who might have longevity, doesn't know how long they're going to live. So that's the situation, and we are going to consider that there is 3% inflation. Okay, so here's a conservative CD buyer. So this is that person who says, listen, I've got $1 million, I'm retired. I no longer need to have any exposure to the market. Again, that's one of those criticisms I hear all the time. I need to put all my money in under the mattress, or in this situation, I'm going to buy some CDs and we're going to give them a really competitive annual rate of 3%, which they would not have averaged in CDs over the last 10 years. And again, we assume inflation is at 3%. For this investor, only earning 3%, which is being offset entirely by the inflation rate, and needing to take out that $5,000 a month, their portfolio will last 14 years. Remember, the husband started at 65, the wife was 62, so they're going to run out of money just when he is 79 and she's 76. So they're going to have to go back to work if they're still healthy and have many years ahead of them, or they're going to have to severely, make some difficult changes. All right, let's look at somebody in the same situation. Now, this is a balanced 60-40 investor. We're going to assume that they get an average 6% annual return. It's just a consistent 6% return. We still have inflation of about 3%. And because they now have some growth, so they're exceeding inflation, where their real rate of return is the difference between the return rate and inflation. So their real rate of return is about 3%, where it was 0 for the previous example, the CD buyer. For this person, their portfolio won't last 14 years. It now lasts 23 years. That gets the husband to 88 and 85 for her. But I have lots of clients, men who are over the age of 88, probably never thought they'd get that old, and feel as good as they do. And we have lots more women as clients who are well beyond the age of 85. So this might not protect somebody even in a 60-40 portfolio, unless part of their plan is, as they get older, their distribution and income needs will fall. And that tends to be the case for many people. You're not traveling as much, you're not spending as much, you're not going out to dinner, you might not have 2 cars, you might not have any cars. Of course, you could have health-related expenses, but you might have insurance to cover that. But if I was solving for an individual just like this, and we knew that they were going to, or likely we knew that they could reasonably live well into their 90s, and let's just say, he would live till 95, and if he lives till 95, she would probably make it till 98. So we've got more years to fund. And they didn't want to make any changes to their spending. And they weren't going to inherit any money. The only thing they could do is if I was doing this through one of my financial planning tools, it would tell me that they can either reduce their spending and their withdrawal rate, or they can go into a more aggressive portfolio and get more long-term historical return. So here's a portfolio that averages 9% a year. Again, we have inflation of 3. That's a real rate of about 6% each year on average. Of course, if it's averaging 9%, that also means that some years it's down dramatically. Like right now, that portfolio, an aggressive portfolio today, would be down certainly more than a 60-40 portfolio, but over a long period of time, it would still average more. And so this portfolio, with more exposure to growth assets, is now going to last 45 years. And if these folks are in really super incredible health and they live past 100 years, they're going to still have assets available for them and to leave to their family. So I just want to point out that even in retirement, especially if we don't know how long we're going to live, and we're counting on our nest egg, our portfolio, to generate consistent ongoing distributions to complement Social Security or any other income we have, and we understand that we're going to have to take out a little bit more because we're going to still be dealing with inflation, we possibly need to have some kind of growth component in our retirement investment plan, and you need to understand that. Okay, so it all goes back to behavior. This is the most important thing. This is where we spend so much of our time in our practice right now when the market's not doing well. We're really focused on keeping people in their plans, making sure they understand that we expect years like 2022. But when it comes to being a good investor, it's all about behavior, and being a good anything else. It's all about behavior. And this is one of my very favorite charts or scribbles, if you will. And it is an intersection between the things that matter in life, and there's lots of things that matter, and the things that we can control. And oftentimes there are things that matter that we cannot control, and we spend a lot of time focusing on those, and they stress us out, and yet there's nothing we can do about it. So what we really want to do is we want to focus on the things that we can control that also matter. And that's where we're going to have the biggest improvements, make the biggest difference in our plans, whether they're around our finances, our budgeting, or anything else in life that is important. All right, here are the behaviors or the factors that drive performance returns over the long term. Number one, it's behavior. It's not getting emotional. It's sticking to that plan when markets are not participating the way you would like them to, when they're not up. It's that percentage in stocks. Over long periods of time, the more exposure you have to broad diversified equities, you're going to have a higher long-term performance. It's the percentage in small cap stocks. I showed you in one of those charts that small caps over long periods of time outperform large cap more often than not. So you want to have some exposure to equities. You want to have some of that exposure be in small caps as well. And then value stocks outperform growth stocks more often than not, also during those longer time periods. So you want to have some exposure not only to growth in your portfolio, but to value stocks as well. And then the things that do not move the needle are these over here. And that's market timing. Still can't find anybody who can do it well. Stock picking is really, really difficult because you probably don't have really good, unique ideas out there. You're getting them from somewhere, and you're not sure who's the one out there promoting it. Watching CNBC, watch it for entertainment only. All those folks giving you advice on CNBC, they've got a bias, and you have no idea where they're coming from. And then, of course, your brother-in-law, your neighbor, the person in the cubicle next to you. Just be careful where you're getting your information. And you should stick with a plan that has worked over different market cycles, and we can all figure that out these days. All right, let me just share some information about dimensional funds and their performance over the last 5, 10, 15, and 20 years. Let's just focus on 10 years or more. And this is just telling us that over the last 10 years, 77% of dimensional funds outperformed their benchmark compared to the industry, 26%. Over the last 15 years, it's 81%, so fairly consistent, versus 20. And then over the last 20 years, it's just about 80%, 79% of dimensional funds outperform their benchmark versus 16% of the industry. I always like pointing out we don't have any conflicts of interest with dimensional funds. They don't help us market. They don't provide us any kind of marketing budget or any kind of kickbacks. These things are very, very common in our industry. They don't send me to Hawaii or Aspen or Europe for a due diligence trip. And while they may have bought me a sandwich here and there over the years, we are only with them because of their performance. And they don't provide that kind of marketing support and kickbacks to any other advisors they work with, even if we can't take them. So our clients aren't paying for those kickbacks that go to other advisors. And because they don't spend money and they don't do a lot of marketing, their costs tend to be low. And the lower your cost, the higher your performance. So we like Dimensional. We'll stay with them as long as they continue to serve their purpose and provide a great way to invest at a low cost with good performance compared to the benchmarks. Okay, so let's focus on what you can control. And this is for people who are still working and for those who are retired. You want to establish and follow a budget and a financial plan. We can always help. Just let us know. You know, I was going through my budget just recently. I found out that I was paying through Apple TV for HBO, and I was also paying HBO directly. And just because the economy is difficult, every year at the end of the year, I print up a couple of statements from credit cards and bank accounts, and I kind of see where I'm spending money, because every once in a while you can miss something. And I've got kids in my house, and you know, they can, you know, order things on TV and order apps that might have a monthly cost that I might not catch. And so this is just a great idea or a great opportunity to look at my budget, look at how I'm spending money. And I identified that problem with HBO, and I also had it with Showtime through Amazon Prime. Okay, select the appropriate investment plan model based on your needs and risk tolerance. So when you have a financial plan, you're actually making sure you have the appropriate investment portfolio that's going to best meet your plan. At the end of the day, take the least amount of risk to get the job done. Some people need more exposure to growth and risk because they have less means. Other people, can get away with a much more conservative portfolio. All right, but find the one that works for you and continue to monitor and continue to recheck and update your plan every year to make sure it continues to work. Contribute as much as you can afford. If you are still working, now is a great time. I mean, right now, basically equity prices are back at some level in the latter half of 2020. So anything you are investing through your workplace retirement plan or directly through an IRA, a Roth, etc., or just investing even as you're retired through other accounts, you might be getting a discount in this environment. So certainly don't stop investing. And if you are planning to retire 5, 10, 15, 20, 30 years down the road, it's going to be in your best interest to contribute as much as you can afford. And hopefully you're doing that with a plan in place so you understand, if I continue doing what I'm doing, where am I likely to be? Because it's always important to know that you're going to hit the mark, or if you're going to miss it, that you know what work lies ahead, as far as, for example, increasing contributions in the future. Set up periodic portfolio realignment. We know of this as portfolio rebalancing for our private clients. We do this, but if you are investing outside of an advisor relationship or through a 401k, for example, you want to set up automatic portfolio rebalancing, and that just makes sure that when stocks go down, you're buying them, you're keeping your asset allocation within the policy, and then when stocks in good years go up too much, you're not allowing your portfolio to drift into a more aggressive portfolio. You're selling off some of those stocks and repositioning that money into the safe column. All right, update your plan annually or as circumstances change. And this is really, really important. For most people, staying invested through these environments makes the most sense if you have a balanced plan that was hopefully set before 2022, and your plan considers the income and distributions you're going to be needing to make from your portfolio over the years, irrespective of how the economy is behaving. But if you have a new health crisis or some other set of circumstances that have changed and were not there as you created the original plan, then that's a very important time. It's a very important time when that occurs to go ahead and update your plan and make sure that it still works with the current or new or changing circumstances. And then tune out the noise. This is so important. Stay disciplined through markets, dips, and swings. We just say that over and over, even in good years, because you just never know when you're going to come across the 2022. We know that in any 10-year period, you typically have one really rough market cycle, one major pullback, one financial crisis, if you will. And then through any 10 years, as I showed you, you have about 2.5 years, 2 to 3 years, if you will, where the market might be down. You need to understand that. And that's when it requires discipline. Always super easy to be an investor when the markets are going up. Everybody makes money. You don't have to be really smart when we're in the midst of a bull market generally. When it counts is when the market is volatile, and it's volatile quite often. That's when it's important for you to stay disciplined. And then we live in such a noisy world, politics, social media, et cetera. We walk around with these, these little computers, and it just hits us with tons of bad information and negative stories because negative sells. And as far as being an investor with all of that noise, it can be pretty difficult because on any given day, you're just reading some just terrible, terrible information about where this market might go from people who have no clue, but they have an agenda that you just don't know about. So just be careful. I have started to tune out and stop my news consumption or reduce it dramatically, and I cannot tell you how much happier I am. In closing, thank you for your time and attention. I hope you learned something. So as we continue to follow developments around inflation, the Fed, and of course the war in Ukraine, we encourage you to always remember that we live in a very noisy world. So look past the headlines, social media posts, and do your best to control your emotions so that you can stay disciplined when it really counts through any market dips and swings that we may experience. Resist the temptation to outguess the market or chase past performance, and focus on those long-term drivers of return and let markets work for you in an appropriately diversified portfolio for your needs and risk tolerance. Now, please follow and like us on social media where we post these kinds of videos and other content. And from all of us here at Mariaca Wealth Management, we wish you and yours the warmest of holiday seasons. Please let us know how we can be of service, and be well.